Olá, boa tarde a todos. É uma honra mais uma vez a gente ter o Jay Peloski com a gente, nosso grande estrategista global. Tem muita coisa para falar hoje, quer dizer, acho que os mercados foram sacudidos aí pelo que aconteceu semana passada com o Fed. Então vamos mudar para inglês aqui e, bom, enfim, anunciar o Jay. Hi everyone, it's an honor for us, to have Jay Peloski again with us. This hour that we have every 15 days goes very fast. We have a lot to talk about, and given what the Fed has done to markets last Friday. So let me without further ado, let me turn to Jay and to our first point that we're going to talk about. So Jay, tell me what is wrong with the dot plot, and I mean, has the Fed made a mistake?
Well, Roberto, great to see you again, and happy to be with Ohm Research on this live, as always. As you said, the hour does go fast, and I think today it's probably going to go really fast because, there's so many things that one could talk about. I mean, I titled my musings on Friday, Gut Punch, to kind of relate to the idea that the belly of the curve on Friday really moved aggressively. And that typically, when you get punched, or like I played American football, when you got hit in the head really hard, you see stars, right? And after a while, like a minute or so, whatever, the stars go away. And so I kind of use the stars and replace them with dots. We got punched in the belly with the Fed commentary, and investors saw dots, moving dots, and it got everybody out of whack. And to me, I think it's a big mistake to really spend much time thinking about the dots. It's just purely governors' opinions on where rates might be in a year and a half to 2 years down the road. It's not a binding forecast. It's nothing more than like a finger in the air to see which way the wind is blowing, and is subjected to change at any point. And I think it's also even more so the case in this instance to not really pay much attention to the dot plot. Here, the dots are being put in place during a time of maximum price volatility in terms of the CPI, as we've talked about for weeks and weeks now, several lives. The recent inflation numbers are very distorted by the base effect stemming from COVID's economic-induced collapse last spring. So those numbers are now gone, right? When we go into June next month, when we look at June's inflation number, it's going to show a significant decline, at least in the year-over-year number, relative to May's number, because that base case effect falls out. So to me, I think it's I've never been a fan of the dot plot. I think this is probably going to go down in history as a perfect example of why you shouldn't pay attention to the dot plot.
Okay, fantastic. So let's start. It would be interesting if we could, real quick go through the cross asset reaction. So you kind of look, can be between now and the Fed decision. Or even between the Fed decision and Friday morning, because that's basically the same. And because I think the Friday movement wasn't really all about the Fed. There was this kind of stress coming from Europe on the news that Italy was going to require quarantine, even for vaccinated people from the UK. So I mean, it looks like rates are basically where they started. I mean, they moved, and the big moves were really on the dollar and commodities, right?
Yeah, I would. Before we get to that, Roberto, I would just kind of reiterate what Chair Jay Powell said, which was to take the dot plot with a big grain of salt, and that means to be very skeptical. It's kind of a common phrase in the English language, and I think again that's completely correct. And obviously, at least on Friday and late last week, investors did not take the dot plot with a big grain of sand. They took it as gospel. And so immediately the whole idea that the Fed is going to have this flexible asymmetric inflation target, that they're going to be data dependent, all the new framework stuff that the Fed has been talking about for quite some time was immediately thrown out the window by investors who just saw the dot plot and said the Fed's going to be aggressive and will quelch inflation before it gets started. And therefore, inflation will in fact be transitory. And therefore, you can buy the long end of the curve and you can sell the belly. And so you had all this volatility in the fixed income space, which I think to some extent freaked out the equity folks who themselves were dealing with, the witching. I think it was quadruple witching on Friday.
Yeah, on Friday.
So, tremendous. I think the option activity was off the charts on Friday. And so there was all this stuff happening. And as you pointed out, it really was cross asset, the bond market, the 10-year, again, it's kind of like with the equity market in the last 6 months, right? I mean, very kind of quiet upward motion on the S&P, but underneath we've had all this rotation activity. And over the last couple of days with the 10-year, it was roughly flat on Friday, but underneath there was all sorts of action from the 2-year to the 5-year to the 30-year, tremendous amounts of action. And so it's really kind of interesting to see how that has played out. And then, of course, in the commodity space, commodities got hit hard, value got hit hard, value growth trade got hit hard, and even Europe and Japan, their equities got hit hard. And so to me, I think you want to take kind of each one maybe individually. So let's start with the fixed income space. Clearly, there was a radical flattening of the yield curve. There was the inflation expectations came in sharply. That allowed people to buy the long end, and so I do think there was, in a way, the message, which maybe the Fed is not all that unhappy about. The message was taken, at least by the investor base, as the Fed is going to be tough on inflation. And inflation will not get out of hand, and therefore we can be comfortable that, in fact, the Fed is going to be right and ensure that inflation will be transitory. Now, whether or not how that all plays out versus the Fed's stated process of wanting to see, full employment, wanting to see inflation averaging 2% in the core PCE indicator for a period of time. Some people are suggesting that if you go back and look at a 5-year average rate and think about where the Fed expects core PCE to be over 2021 and 2022, roughly 3.4% this year and a little over 2% next year, you'll get to that 2% average inflation, average core PCE inflation. And so that would suggest that the Fed is simply trying to say, look, we are going to taper at some point. We're most likely going to announce it in September. That's been consensus. Most likely going to start in the first quarter of 2022. That's consensus. If you think about reducing the asset purchases, which are running at $120 billion a month right now, take 10 billion a month off, or 15 billion, you're talking 8 to 12 months of tapering. That brings you into the beginning of 2023. And then perhaps, depending on what things look like at that time, the Fed will decide whether or not it wants to raise rates. The markets have already moved way ahead of that. So if you look at the December 2022 Euro-dollar futures indicator, they're already pricing in one hike and pretty much 60 to 70% towards another hike, which I think is way out of bounds. I think the likelihood of the Fed raising rates in 2022 is virtually nil, as opposed to it's already priced in at the moment. So I think, long story short, I think the bond market is ahead of itself in terms of thinking about what the Fed is going to do. And I thought it was constructive today to see that rates backed up on the long end, right? The 30 years at 2.11. It started today right around 2. The 10-year was backed up a little bit. It's about 1.49, 1.5. And even the 5-year kind of rallied a little bit, which I think is good. So the spread, the yield curve steepened a little bit. So I think all of that is good. I don't want to see rates fall significantly from here, particularly on the 10-year, because I think that will signal that there really is a growth slowdown coming up upon us quickly. And as I wrote 2 weeks ago in my bear case musings, which got a tremendous amount of attention, really all around the world, got a lot of attention. The risk is that the Fed is leaning towards tightening at a time when growth is already slowing. And so we don't want to see rates go lower. Actually, and so now we need to think about higher interest rates are bullish, right? They'll restore the thought about the value trade. They'll remove the concern about a growth slowdown and a Fed policy mistake, because the policy mistake discussion definitely kind of materialized over the weekend. The policy mistake is that one, that the Fed is been spooked by the spike of the last couple months, which is we already talked about, is no longer valid because the base case effect is falling out of the CPI. But nonetheless, the dot plot was made during a time when when inflation spiked, freaked out the governors. They made their dot plot. That in turn freaked out the market. The Fed is now leaning in everyone's mind towards tightening at a time when underneath all of this, there's a sense that maybe U.S. growth is slowing, or certainly has peaked. Q2 is going to be the peak in growth for the United States year over year. The question is what happens next. Now, naturally, since we're growing at 7% per annum and we're a large, mature industrial economy, we're not going to sustain that. So it's a natural deceleration. The question is to what level. And I would just note, and this is research I did over the weekend, ECRI, which is one of the leading economic forecasting companies in the United States, came out saying that there is a growth rate cycle slowdown coming into view in the United States. Now, they don't put a number on what that slowdown is. And so to me, again, it's this kind of uncertainty of the environment that we're in, that clearly we're going to slow. And whether growth is 7% in 2021, going to be 3% or so in 2022, obviously that's a slowdown. Fiscal stimulus, which is somewhere around 10 to 15% of GDP last year and this year, is going to slow to 2% next year. So the fiscal side is going to be a drag on a relative basis. And so all these things coming together, and by the way, ECRI also points out that what happens following a growth cycle slowdown, an inflation cycle slowdown, comes shortly thereafter. Again, with a lag, but so that would argue to me that this inflation fear, which I've never really, I'm a transitory guy. I've never been a buyer that we're going into a permanently higher plane of inflation, or one that's going to be worrisome. I actually think that 2% inflation for a couple of years would be a very good thing for the United States, as well as for Europe to have higher inflation. Yeah. The issue is not inflation's too high. The issue has been that we have not been able to get the economy going to a strong enough level that we would have inflation. And as we all know, or should definitely remember, when you have a lot of debt, you want to have inflation. The last thing you want to do is have deflation. So all of this is to say that I think what's really becoming important is the potential for the Biden jobs plan and families plan to get passed, because I do think that stimulus may well turn out to be necessary, even though, again, in the current environment where all we're hearing about is, inflation, fears, et cetera, I do think there's a little bit of worry within DC about putting on more stimulus. Now, as I've suggested for some time, the time to really understand some of this is when we get into the late summer and fall, when we have cleaner data that we're able to kind of get a sense of, okay, where are we post the base case effects from last spring? And the last point I'd make before I stop and we can, I guess, go on to the other assets, is that I took a look at how long the House and Senate are in session for the next several months. And this is vacation time all around the world, or at least the US and Europe. And for sure, Congress is going to be on vacation. So listen to this. In between basically the next week and Labor Day, which is in early September, the Senate is going to be in session for 16 days out of the next 2+ months. And the House is going to be in session for only 9 days over the next couple of months. So, I mean, doing the people's work they don't seem to be doing too much work in this. This obviously is going to complicate the passage of the jobs plan. And it does look like the idea is to split the two packages or to have two packages. One, the infrastructure potentially via a bipartisan bill, and then the second larger kind of family plan is likely to be done via reconciliation. And so there's an awful lot of moving pieces, not a lot of time. And right now the concern is that the economy is running so hot that we don't need stimulus. I think it's going to be quite possible to think in 2 months it's going to be seen as almost critical to averting a significant U.S. slowdown. So all that suggests, obviously, that there's a lot of moving pieces, and people are going to have to pay attention as we go forward.
No, this is excellent, and I mean, there's a lot of questions here, and people asking mostly about commodities. I think you answered part of the question already, which is the growth steer, I think one of the things we were discussing before we went live is that I agree with you on the transitory nature of inflation. Something I've been saying, and of course, because of what you've been writing and borrowing on your call, is that if you're too worried about inflation, most likely you're between 3 and 6 months late. So now the issue is really growth. So I mean, what are commodity markets telling us? That's very important for Brazil and Latam.
Sure. No, I think that's exactly right. So I'm definitely of the view, and particularly have been writing that over the last couple of weeks with my bear case, that the risk is not too much inflation. The risk is a growth slowdown with a Fed that's leaning towards tightening and will therefore be at risk to making a policy mistake. That's the big risk. I don't really see an environment, given the fall of the leader and first in and first out with COVID that we've talked about now for months. China is clearly slowing. China has clearly, its growth rate has rolled over. It's slowing. Now, it's still, again, pretty robust. And just to give you an illustration, industrial production, not versus 2020, but versus 2019 in China, is up double digits, up around 12% in the first 5 months of the year. Retail sales in China are up 9%, 2021 versus 2019, January to May. So while China, again, you have to be making broad, big statements in this environment is tricky. So China growth has rolled over, but yet it's still robust, right? The U.S., given COVID first in, first out, is next. Growth is peaking right now as we speak in the U.S. Q2 will be the year-over-year peak in growth. And then we have Europe, and then we have emerging markets. And as I've talked about, importantly from my point of view, is that we're moving from a staggered reopening process that we just laid out to a process by the end of the year where we're going to be in a synchronized global recovery. And this is obviously important for commodities, right? So what I would say about commodities is that they had been red hot. Now they're just the latest little bubblet to be pricked by this market. And we've talked about this as well for months and months, this market has been extremely efficient and effective at pricking any little bubble that kind of starts to expand. And you talk about the FANG stocks from last fall, GameStop and the meme stocks or the meme stocks in January and February. Talk about crypto. Talk about commodities of late. So to me, that's healthy. We want these pullbacks because we're early in what I think is going to be, multi-year moves on non-U.S. equity, on value, on commodities. I think we're in the beginning of a super cycle in commodities. And so it's actually healthy that we have these pullbacks every once in a while. They may be a little bit painful, but I think they're healthy because they're going to provide us kind of the lockstep to go higher. So as I wrote again a couple of weeks ago, I think in the monthly second half outlook, the pause that refreshes, we want to be sure not to get shaken out of these long-term trends by short-term volatility. So one of the challenges to be an investor today is these moves, these sell-offs come super fast. And mostly because the trading day-to-day is done by algorithms and by machines. And so as a mere human, I don't think we want to try and trade those and try to outfox the machine. I think that's a losing game. I think the winning game is to be, properly positioned and sized in your allocations and your exposure, and having themes and views that you are able to kind of stay with. And when things run, you take little profits off the top and reallocate elsewhere. When things sell off, you can look to take some of that money and put it back to work. So to me, the commodity move, I think, is simply, for the most part, profit taking. You did have the Chinese talk about, releasing stockpiles. So that really, the industrial metals were already kind of, feeling the effects of that. Copper's off, 10% or so.
Yeah.
Lumber in the U.S. With the housing, lumber's off 40%. Grains have got smacked late last week, and they're off, 5 or 10%. But to me, I think you have a situation where commodities are likely to be, as I say, in a multi-year super cycle. For all sorts of reasons, having to do with the push to clean energy, ESG related concerns around financing, the time it takes to bring supply online for commodities, et cetera, et cetera. So to me, that's an area of opportunity when you get pullbacks.
Yeah, no, we agree. And I guess, what you said about, commodities is going to leave, a lot of people on this call, calmer. And, there's a lot of questions on this, as you can imagine. So, the other thing, I think, if there was one clear move, even the first day was on the dollar. It's a bit weaker today, but, the mighty dollar is probably up, since then, about 2%. Against euro and most currencies except for the real, and we'll talk about that later. So what does that it looked like there was almost a consensus. Whenever there's a consensus that the dollar is going to depreciate, then something comes. So what's the outlook this day?
Yeah, the dollar again is somewhat tricky. I've been in the weak dollar camp with the view that we're going to go to that synchronized global recovery. That means the rest of the world is going to capital is going to flow to the rest of the world. That's dollar bearish. So the last couple of days on that front were not great, but it's been an aggressive move. The dollar's been up actually, I think 5 of the last 6 weeks, DXY. And I believe the move, the 5-day move that ran through Friday was the second or third most aggressive move in the last 5 years. Just to put that into context. It was a really pretty aggressive move. And I think part of that is simply just short covering because there were a lot of dollar shorts out there. And I think that kind of, again, that kind of super fast reaction, aggressive reaction, speaks to me of people being offsides and having to get onside real quick. And there you go. You've seen it. But I think, to me, I'm watching, and as I've said before, and we've talked about on the lives here, the technicals are important, right? In these markets, technical levels are important. And for me, I'm watching like 93.50 or so on the DXY as an important level. If it gets above that, that suggests, at least according to folks who are more technically driven than me, that would suggest that the DXY may have some more room to go to the strong side. My own feeling is that this was, again, a positioning issue. There were a lot of dollar shorts. They got toasted. They had to get out, and therefore we had the dollar have one of the biggest moves it's had in the last 5 years. Yet the fundamentals do not really support that move, and particularly if we're right in suggesting that inflation is not going to continue to skyrocket, that growth in the U.S. is peaking and is going to start to decelerate. And therefore, this idea that you could buy the dollar because the Fed's going to be more aggressive than other central banks, I just think it's so far away that it doesn't really, that thesis doesn't resonate with me. So I've never been my view has been that the dollar weakness is more against things like the Brazilian real, right? Which I'd note again today had a pretty big up day and back to right around 5 on the dollar. And, it's probably going to chop around 5 because that's a big round number. But most fair value estimates that I see for the real versus the dollar are around 450 to 420. I don't see any reason why, that's not likely to happen in the next 6 to 12 months. So we've had a big move from 575 to 5. And now we chop around a little bit, but I don't see a lot of downside risk to the real. We obviously know the central bank is tightening and is likely to continue to tighten. We know growth cycle is picking up. We know there's the commodity demand that we talked about earlier. There's a big drought in Brazil, as I don't need to tell you or the folks on the call, but that's obviously going to have an impact on things. So to me, it's not so much that the euro is going to appreciate dramatically or the yen is going to appreciate dramatically. It's more that I think there's some opportunity in some of the emerging market FX that got pretty badly oversold over the last year or so.
No, that's great, and we all have talked about the transitory nature of inflation. We agree, and. One thing I'd like to remind people is, and I think Jay agrees, and we have talked about this before, is that, for the Fed mostly, because people have to take this into perspective and always have this in mind, inflation is mostly labor inflation. And Jay makes a great point about, on one hand, we have, the physical price pressures coming from, the simultaneous reopening and and the bottlenecks and everything. But on the other hand, we have the digitalization of every service, and not only is a lot of slack in the labor market, but also labor does not have a lot of bargaining power as it used to in the 70s, which is what people have in mind when they talk about inflation and these fears and so forth. So just to cap on inflation. Do you want to add something about these points?
No, I think you encapsulated them well, right? It's the physical price pressure of commodities versus the digitalization of everything, and it's it's important to note that there are some arguments that the potential for a productivity surge in the U.S. is really starting to manifest itself, and partly driven by the acceleration of COVID, right? The COVID speed argument that we've talked about for months and months. So I think there is, look, we want more people in the United States to make more money, right? The problem has been that there have been, some people making a lot of money and a lot
Yeah.
of people not making very much, and that needs to be kind of addressed. And I think hopefully that will be addressed as we move forward. But we want to see people in the low earning wage groups in those jobs. We want people to get paid more money. And that's a big part of the policy approach of the Biden administration to focus on income equality, to focus on it's not a great word, but redistribution, and kind of smooth out some of the economic imbalances that have manifested over the last decade, and which are still manifesting, because as we know very well, the financial folks in the financial industry, or who are investors, have done great. And this is an important point in the sense that the net worth of people in the United States has really done extremely well over the last year or so, because not only have stock prices gone higher, but house prices have gone higher as well. So for the majority of Americans, and this is important to think about when you hear about quit rates and people not rushing to go back to work, the majority of Americans, these being people who have financial investments and who own their homes, and that's not everybody, but those who do, both of those things have done well. So the net worth and net wealth position of the average American consumer is better than it's been probably in decades, if not record in terms of its how strong that is. And so that's another point to keep in mind. But to me, the idea of we're going into wage cycle inflation, we still have 10 million unemployed Americans, and so I think we're way far away from that. Right? We got down to 3.5% unemployment before COVID, with no sign of wage inflation, and we're right now at what, 5.8% unemployment. So again, in 18 months, 24 months, we can have that discussion and see where we're at. But to kind of, and this is again going back to the dot plot where we started, to decide policy or investment positioning based off of random guesses about where inflation is going to be in 2 years is just, I don't think it's worth doing. I think it's a mistake.
No, fantastic. And what you just said, reminds me, of 2 points. I want to ask, a couple of questions. One is on productivity, and you already mentioned the Congress activity, and they will be mostly on holiday for 2 months. So, but now I've looked at the news in Europe, and a lot of the EU has approved the disbursement plans for a lot of countries. They have approved Spain, Portugal. I think yesterday was Austria. I think Italy's on the way. Is that and plus the fact that China is a state-led economy. So I mean, they already they have already the China made in China 2025. So I mean, are these things going to make Congress more sensitive to to the Biden productivity agenda? So that's one of them, and then I'll
Yes.
ask the second one.
Yeah. Stop there. That's a big one right there. No, and I think it's a great question, and I do talk about that in the musings where I said, we're all macro investors now, right? We're now focusing on the Biden fiscal package, and I think, look, this is very, very important, because ultimately we don't want to just go back to where we were pre-COVID, right? We want to do better than that, right? That's the whole idea of the Biden Build Back Better. So to build back better, we need kind of have first the pro-cyclical Biden fiscal stimulus, right? It's pro-cyclical because the economy is doing well. We're adding more stimulus. It's going to continue to do well. We have the potential for a long overdue in the United States CapEx surge, right? Capital expenditure, both public and private. If you go back and look again, public and private CapEx relative to GDP in the United States is at a 30 to 40 year low. 30 to 40 year low. So there's absolutely no argument again, or there shouldn't be, that we need to spend money on infrastructure in the United States. So that's the second point. And then the third is this idea of a productivity surge. And I actually included the article that I read about that in my musings. I linked it. It's an MIT article, and it talks about the power of three. And this is the power of three is something I've written about myself, and I'm a big believer. And in the three things here to drive productivities over the next half a dozen years or so are, first, leveraging the tech gains of the last decade, right? So a lot of things have happened in tech in the last decade, and now we're going to leverage them. Second is the COVID speed acceleration of the tech adoption, right? So we've all heard about how, all these tech businesses kind of jammed 3 years of activity into one. So that's the second point. And then the third is that you're going to have a fully employed economy running, at above trend growth that will stimulate focus on productivity by corporates and individuals, as well as the government. So I think this is a very important idea to think about, again, because if we want to be bullish, more than just a cyclical trade, if we want to make the argument that we're early in what could be a multi-year bull market with, particular performance, and hopefully we'll talk about the non-US equity markets at some point today. But if we want to get into that thesis, then we need to kind of have some of these building blocks. And so fiscal, the jobs plan and the families plan going to be very important, because that will address the fiscal, it will address the CapEx. And then the third, the productivity surge, is something that we have to watch and pay attention to. But certainly, from the TPW advisory point of view, clients know, and those who are subscribers to our model portfolio delivery service know very well that I'm very focused on that particular aspect through the thematic investing. And we even have our TPW 20, right, which is our 100% thematic model portfolio. And so that's how we're expressing and focusing on that productivity surge, investing in things like robotics, the clean energy focus we've talked about, carbon, electric vehicles, et cetera. There's a lot going on there. And I think, again, investors need to have an understanding of how and where the world is going. And I think you're absolutely right. And I'll finish here that, China has been elevated in the US to a strategic competitor. So it's no surprise that we're starting to mimic them a little bit with kind of the industrial policy. Europe, clearly, as we've talked about before, is the best positioned, I believe, the best positioned of the three main regions, Asia, Europe, and the Americas, in terms of its medium-term outlook, because of the Joint Recovery Fund, which is just now starting to disperse funds. And so for the 2021 second half, or 2022 to 2025, Europe is actually probably in the best position, because it's already set. Their medium term is already set. Where the US, we still have to get through all the things we just talked about. And so I think you're absolutely right. Industrial policy, public-private partnership, more guidance by government as to CapEx and investment and spending and research, et cetera. All of that is part and parcel of the environment. It's very much along the lines of regional integration, right, in the tripolar world. And B, it also is somewhat reflective of the need to deal with China as a strategic competitor. And then C, it really resonates with the idea of trying to improve a more equitable, inclusive economic growth profile for America as a whole, not just for certain segments of the population.
Yeah, this is great. And what you just said, made the link to what I'm going to ask on Europe. And there are some questions about this, so we can go into sectors and stuff. So as we were chatting before, so you talked about China. So I'm going to use the China link to address Europe. So as we were talking before we went live, I was mentioning the elections over the weekend. So there was I mean, it's still early to call. The turnout was low, and there's the second round next week. The regional elections in France, the former National Front, was less well than expected, and in the center right, the former UMP, which is called the Republicans, did better than expected. But I think what's more interesting, and I want to comment on, is Germany. Given their, of course, importance in Europe, and it looks like Merkel's candidate is leading, so he has a very high chance of being her successor. His name is Armin Laschet, and he has a view, and Merkel said the same thing, of China being a competitor and kind of a threat in some areas, but they also think they need to cooperate with China. And also, he's of a view that Europe should normalize, relations with Russia. It's on its best interest to normalize that. So how do you translate, what he says into your call of strategic autonomy for Europe, and what does it mean for your investment case?
Great. Well, I'd say first of all that again, Europe was weak last week. Got hit reasonably hard. Again, I think it was healthy profit taking, as I mentioned in my musings, right? Europe had been up 9 days in a row, I think, before Tuesday, Wednesday of last week. The longest winning streak, Roberto, since 1987. So if you want to know where Europe has been for decades, right, it's not been the place to be, in the sense that 9-day win streak is the longest since 87. I mean, I was around in 87, but just barely. You probably weren't even around in 87. So that's, something to think about in terms of Europe. So when you see Europe down a little bit, again, perfectly fine, healthy profit taking, and allows us to reposition, to move higher based on the reopening. JP Morgan did some great work showing over the weekend, showing how the cyclical earnings in Europe, the sectors are cyclical. You mentioned sectors. The cyclical sectors, their growth rates, their EPS growth rates are significantly better than the defensive sectors. And I think European earnings growth is going to remain robust. I think JP Morgan is looking for 50% year-on-year earnings growth in 2021 versus 2020. 50% earnings growth in Europe, which is pretty wild to think about. And they also are constructive.
That's for the full year?
Yes. Yes, for the full year. And they are also constructive on 2022. Morgan Stanley is, it's now, Europe is now becoming kind of consensus in terms of people wanting to be overweight European equity. I think there's still plenty of room to go, particularly if we're able to have that medium-term outlook, which I spoke of. To me, the Joint Recovery Fund, the focus on issuing green debt and have that be, collective European Union debt, have that become a safe asset, replacing the bond, which is illiquid and doesn't really signal very much, I think is all very, very constructive. There's now talk of trying to push the banking union. I mean, Europe, from an American point of view, moves very slowly, but the direction of travel is a pretty good one. And I expect that, I hope that direction of travel picks up and continues to pick up. And they too use the crisis of COVID to make changes that are significant. And I would just point out in Germany, not only the elections, but also the continued discussion about spending, going more into debt, taking on more debt to stimulate the economy. There was a report over the weekend of another 100 billion in fiscal stimulus in Germany for 2022, I believe, for the budget, which is upcoming. This is very constructive. The fact that the deficit ratios and the kind of the fiscal instability guidelines have again been relaxed through 2022. That's constructive. That means Europe is not likely to shoot itself in the foot as it tries to, really move forward. Arguably, more could be done, and there are many who argue that even with the Joint Recovery Fund Europe is not being as aggressive as it should be. Certainly not as aggressive as the U.S. or even Japan in terms of fiscal spending, but it's way better than what has happened in Europe. And we'll have to see how things play out. I think it's clear that the ECB is going to take its time tapering. It's going to take its time, as well it should. Inflation is not an issue in Europe. And again, we would like to see, I think, higher inflation in Europe, actually get to 2% inflation and keep it there for a period of time. The challenge in Europe is deflation, as we know very, very well. And then last, on China, Europe exports more to China than they do to the U.S. China has become the major trading partner, and therefore it has a bigger seat at the table when the Europeans think about, how do they want to play the U.S. versus China. And again, this is this is the tripolar world, something I've been talking about for a decade. It is China in Asia, it is Europe with Germany, and it is the Americas with the U.S. And increasingly, the three are trying to figure out how to play with each other in climate and things like that. They have to work together and then kind of compete with each other in terms of geopolitical security and strategy and things of that nature. And I expect, and this is the one kind of critique I have so far of the Biden administration, is that I think that on the foreign policy front, they seem to want to go back to pre-Trump days and that would be perfect. And I think that's a mistake, because the world has moved on. Not only, the world can't unlearn the America First policy approach of the Trump administration, but China has also become much more significant in the last, 4 to 6 years for many countries. ASEAN in Southeast Asia is increasingly integrating. And so, the world understands that in terms of growth of consumer and consumption, that ASEAN, Southeast Asia, is where the action is and will be for the next decade, in India as well. And so, Europe is very focused. Europe is an exporter. So they're very focused on where those end markets are and how do they best participate in them. And so they're highly unlikely to agree with the Biden administration or with the Trump administration that, we should really put China in a box and not deal with them. And so I do think you're right that maybe there is going to be a little bit of a rapprochement between the US and Russia as a way to get the Europeans kind of on board with focusing on China, if you can understand kind of the redirection that would suggest. But this is all, this is big geopolitical stuff that really doesn't necessarily impact investments. I think more from the investment side is the realization that each region is going to have its own industrial policy. That the idea, one of the thoughts I've had, for example, is that people used to say, you can just buy the S&P and get your global exposure that way because, 40% of revenues of the S&P come from outside the United States. I think that's increasingly going to be less true as companies have to really focus in each region, right? And taxation is changing, as we know, right? The 15% minimum tax. I think there are a lot of things changing that does suggest that from an investment perspective, the framework of the tripolar world of understanding each region as almost like a standalone entity, and then thinking about them, how they play off each other, and how to invest in each one is increasingly going to be the way people think about things going forward.
Fantastic. No, that's great. And now going back to our emerging markets. So as you wrote in the Musings, it doesn't look like the fragile five are as fragile as they used to be, right?
Mm-hmm. Yes, and I got that from some work I looked at over the course of the week, showing that the current account deficits and the external liability of the Fragile Five is nowhere near what it was in 2013. And yet, when you have talk about taper, boom, everybody just goes back to the same playbook and says, "Oh yeah, in 2013, EM got crushed, so let's get rid of everything that's EM related," even though the positioning of the countries is much better, in part because they got crushed in 2013. So they no longer have anywhere near the foreign liabilities that they had. Their reserve positions are much better. All those factors that suggest, it's just it's lazy. It's just like all this talk about bubbles, like, public market bubble. The S&P's in a bubble. It's just lazy talk. It's not at all. It's not at all accurate. And in a way, as investors who do the work, right? And I think, at least for myself personally, I pride myself on doing the work. If you do the work, that's an opportunity to not listen to the lazy talk of bubbles or, sell EM because the Fed's going to taper in 2022, 2023. I mean, I think that's just, maybe if you could trade for $1 or something, on a couple positions, sure. But that's not the business I'm in. If you're looking to invest longer term, invest thematically, I think the opportunity set in EM is decent. Have been and remain of the view that non-US developed markets are really want to be Europe and increasingly Japan. I think Japan is next. I think the Olympics are going to be a success, and you're going to see the story on Japan change from, horrible job on COVID. What are they doing with the Olympics? Shutdown, lockdown, to Japan succeeds and carrying off a wonderful Olympic display. Vaccination process has been a success. Companies are super cheap, cash rich, nobody owns them. Cyclical play on a synchronized global recovery. I mean, you can almost lay out, what the story is going to be in the next 6 months. And so we're again, if you're a client of TPW's model portfolio delivery service, you are participating in Japan right now. And so that's where I think the opportunities are in Japan. I think in Latin America, we've talked about it. One of the biggest positions in the model portfolio, in the multi-asset one, not thematic, is Latin American equity. And I'll note that one of the two big firms, I forget whether it's JPM or Morgan Stanley, just upgraded Mexico and Brazil. Others have done the same thing. It's one of our single biggest equity positions. And I think we're early in that process. And by the way, Latin American equities held up very well last week, very well. Almost, broke the 20-day moving average, but didn't come close to threatening the 50-day or the 80-day. And they've had a big move. They're one of the big winners of the last 6 weeks or so. So that, again, tells me that people are not really invested there and don't want to sell, and are waiting for the reattachment of Brazilian equities, for example, to the commodity cycle, and want to see that as an opportunity to go higher. And so in emerging markets, the opportunity set, as I see it, is primarily in Latin America.
No, we agree, and as you pointed very well, I mean, we have had quite decent correction in commodities, and the market didn't do much. In Brazil, of course, you have the issue of the hawkish central bank, and what that does to the real. But we agree. And the question I had way back was, and it has to do, as you talked about lazy talking. I've been asked about housing bubble in the U.S. and let me know if what I've been saying is correct. But I said that's not the case, given that we don't see even the resemblance of the kind of behavior that took place between 2004 and 2007, where there was a lot of leverage, credit given to people that did not were not credit worthy. And people just using their homes as ATMs. So is that the correct answer? Number one, and is there something you'd like to add?
Yeah, I mean, to me, it's very simple. I just look at the mortgage applications. That's the leading indicator to housing, and they rolled over months ago. So, the demand for mortgages, for financing has ebbed considerably. So again, the idea that we're in a housing bubble is just doesn't make any sense. Yes, houses in certain places, namely suburban locations outside of major cities, have got a serious bid to them because people post COVID or during COVID have wanted to be out in the countryside. But that's already changed, and so naturally when you have higher prices and fewer houses, right? The inventory has gone way down. That therefore it puts housing out of reach for certain people, and therefore the demand slows, and that's where we're at. And you can just see it with lumber, right? I mean, again, lumber, is down 40% from its peak of like 2 or 3 weeks ago. So this is that's kind of a confirming signal that this idea of a housing bubble is inaccurate. Therefore is not something to really worry about. I mean, I'm just, the relationship between mortgage applications and housing is pretty well known. And yet it seems as if, with COVID, and the story is too sexy, the story is too interesting to hear about, the cities are dead. I mean, I'm in New York City, right? All I've read about for the last year is that New York City is dead. And I've been here the entire year, and I can assure you it's not dead. And it's most definitely not dead now. But, it's such an easy story. Cities are dead. Suburban country living is where it's at. And everybody wants to buy the house. I mean, if you're at all thoughtful, you would not be buying the house in the countryside now because they're up 20, 30% versus what they were a year ago. And probably a year from now, if you try to sell your house that you bought at a 30% premium, you're probably going to have to sell it at a 20% discount because that 30% premium is artificial. It was just driven by COVID. It's not real and not sustainable. So yeah, I don't see housing in a bubble. I mean, to me, as I said, the opportunity that's exciting is that you can, are we going to be able to push the U.S. economy and the European economy into an above trend growth path? And if we're able to do that, and if the trade is to have inflation run hot, i.e. like 2% or 2.5%, not 5%, but run hot for a period of time, that's a trade I would think as investors we would want to take all day long. That is historically quite good for equities. And so rates in that environment have to go up. And as I said at the beginning, and I know we're closing, so maybe we'll circle back and end where we started. We don't want to see rates in the U.S. decline from here. We want to see higher interest rates, which support the thesis of growth while rolling over, while peaking, is not going to decelerate into anything other than a growth path of 3 to 3.5%, which, if sustained, would be a great environment for earnings. And by the way, stocks are now selling at 19 times next year's earnings. We know when we come back from the summer, we're going to be focused on 2022.
Next year, yeah.
It's not that markets are not expensive. Europe sells at a discount to the U.S. Japan sells at a discount to Europe. EM is not expensive. So I think that that's the potential setup. And so my view, again, is that we're going to shift from a staggered reopening to a synchronized global recovery. I don't think we should pay much attention at all to the dot plot. I do think we have kind of today's action is more valid, let's say, than Friday's action as a indicator of where we're going. I admittedly am talking my book, but I think that is how I read the situation. And we'll have to see, we'll have to watch the fiscal situation in the U.S. pretty carefully here to see if the Biden administration is able to get one or both of those packages through in what's going to be a vacation short period here for the U.S. Congress.
Yeah, no, that was fantastic, and you kind of wrapped up, with your recommendations, and it was a great conclusions. Just to remind you, you said something very interesting, on the point about housing when you talked about lumber, because a lot of the inflation fear mongers, I think one of their poster child was exactly lumber. What was going on with lumber? So here it is, once again. What you're saying about the capacity of the market, to break, isolated bubbles. So of course it has to do with COVID and construction activity and so forth. And it's we're just coming out of something that happens once in every 120 years, right?
Yeah, well, you have supply bottlenecks and prices. People have to have it, and they'll pay any price for it, and that's a self-correcting mechanism, because at some point, people, fewer and fewer people are going to be willing to pay, and then the price has to come down, and boom, that's where we're at. I mean, I think again, my view, we want to be long non-U.S. equities. We want to stay with the value trade over growth. We want to be long commodities. We want to be underweight fixed income, particularly government debt, and I think we're going to shift to Europe reopening, then Japan, and EM, and really what's pretty exciting now, I think, is going to be Japan. You can see the headlines already. They're going to be successful with the Olympics, going to have renewed attention. So if I was looking anywhere right now, I think Japan is probably the best place to think about putting money to work right now.
Fantastic. So yeah, we just went over the hour mark. So this was excellent, and the audience was great, and we had a lot of questions. So thanks again, and we'll see each other in 2 weeks. So as Jay says, stay the course, ignore the noise, just keep calm
and carry on. Thanks for
carry on. Thanks a lot, Jay.
Bye bye.
Thanks everyone. Bye bye.